Hello everybody, welcome to Housing Bubble 2.0 News of the Week, or as I like to call it now, as the virus turns the mortgage crisis into a housing crash. Okay, that basically is what's happening right now. We're getting set up for that. I'm Randy Patrick, your host, putting the realism back in real estate. A lot of stuff to talk about today, especially want to talk about what I call the forbearance bait and switch. That'll be towards the end of the video because I want to lead up to that right now. So what we got on the go today is a lot of stuff. Every week that goes by, we hear more and more information, statistics, numbers increasing, situations, whatever. A lot of stuff the thing here is that we're seeing this unfold in real time right now, which is quite interesting and gives us the ability to maybe react a little better than we did through the last housing crisis. So if you're not already a subscriber, please click the button on the right of the screen here, help my channel grow. I appreciate it very much. Thank you very much. Okay, great. Here's what we got today. So 1 in 5 Americans lost a job because of COVID-19, initial claims show. So we just had another report about unemployment insurance claims. So jobless claims rose by 4.43 million last week, the Labor Department reported. So now we're at a coronavirus-related job losses to 26.5 million. And that basically is within the first, 4 or 5 weeks here. Yes, this means that 1 in 5 working Americans who lost a job since mid-March, when states grappling with limited testing abilities to trace an already deadly virus that so far has no approved treatment, began ordering people to stay at home to stem the death toll. So basically we were at all-time highs at this point in time. And if you recall, a few weeks ago you had a lot of analysts and economists suggesting that, hey, the potential unemployment could hit maybe 30 million people. When you first heard that, you thought, what, that can't be true. That's a lot of people. Well, guess what? We're at 26.5 million, and we still got basically 1 more week to go with the month of April. So, that this is not a stretch. We get another 3.5 million people next week. Guess what? We're at 30 million people, which is pretty much what the economists predicted this would at least give us as far as job losses. Last week's jobless claims translate into an unemployment rate of about 20%, which is double the peak reached during the financial crisis a decade ago, according to the Labor Department data. So there you go. So we're at 26.5. Looks like we'll be approaching 30 a week from now. We'll see how that goes, but that's certainly a lot of people who are out out of work, and that's going to have a domino effect. University of Michigan, they do a big analysis on consumer confidence. So basically, University of Michigan consumer sentiment crashes by most ever. Home buying conditions worst in 37 years. So the University of Michigan's final sentiment index for April slumped 17.3 points. Basically, the measure, while the lowest since 2011, was higher than the median projection of 68 in a Bloomberg survey of economists. So basically, we're looking at about a 71 score. So I guess it came down from about an 87 and changed to a 71. Buying conditions collapsed across the board, with home buying intentions at their lowest levels since 1983, and buying conditions for large household durables are the worst ever. So large household durables, I'm assuming, are large purchases that people would make normally in their course of life and business. While all income levels are affected, it appears the wealthiest suffered the biggest drop, but the poorest are at the worst level since 2013. So there you go on that. So again, everyone feels the same way. Home buying and the real estate market is not good to participate in right now for a various number of reasons. Now, to support that, guess what? U.S. new home sales have never dropped this much in March ever. So after the plunge in home builder sentiment as they are forced to face reality and the big drop in existing home sales, new home sales were expected to tumble in March after already dropping in February, bucking the uptrend in existing and pending sales. New home sales crashed 15.4% month over month, the biggest drop since July 2013, smashing the year-over-year comparison down 9.5%. So basically, from the best level in 13 years, a couple months ago, sales are crashing fast, and the last 2 months were also revised downward. Now, think about the new home sales. This is from the U.S. Census Bureau and Department of Labor. One of the information is difficult to get, and they usually release it and then they revise it maybe a few weeks later. So the previous months were revised to be lower, and we got 15.4% month-to-month decline in March. So really, for me, that's the median sales price of a new house in March was $321,000. The average sales price was $375,000. Every region posted a month-over-month decline, with new home sales in the Northeast falling 41.5% from February. So this is the scoop we're dealing with now. We have existing home sales that were falling big time. We have people who are pulling their homes off the market, not wanting to list homes or have open houses or showings, etc. Curious about who can actually afford to buy a home these days. And now we see the new home sales are getting creamed as well too. So just goes to show that it's getting hit on all fronts here. The mortgage meltdown. So the mortgage crisis is going on now. So obviously we have people who are out of employment, out of work, losing their jobs, getting laid off, furloughed, whatever you want to call it. That's obviously, putting a lot of chaos into people's lives. But mortgage market meltdown. So even the wealthiest loan applicants are now being turned down by lenders. So what typically happens when we have a mortgage crisis that leads eventually to a housing crisis? Lenders do what? They tighten up all their standards and their guidelines because, as I've mentioned before, nobody wants to be that lender or that underwriter that approves a mortgage and then the people default even before their first payment is due. So their first payment, they're out of work. Oh, we've got a problem here. So that basically means now that maybe the underwriting wasn't thorough. If you think about it, a lot of people don't have any indication they're going to lose their job or be laid off or get furloughed until it actually happens. So you can't fault the homeowners for doing this. They're looking to jump into a mortgage, buy a home, life goes on. This is certainly a completely unique situation that we're dealing with right now. So the global pandemic has mortgage lenders steering away from even the wealthiest clients as fears abound that lost income could turn the industry's best clients into biggest risks. Now, jumbo loans, which got their name, of course, because they were bigger than most conventional mortgages, have completely fallen out of favor with lenders, a far cry from how they were looked upon just months ago, according to Bloomberg. The availability of jumbo mortgages is down 37% in March, more than double the overall home loan market. The problem with jumbo loan mortgages is the fact that there's a FHA or in the government, they have a level as to what they'll guarantee as far as loans are concerned. A lot of these jumbo mortgages could be $850, $1 million, whatever, because people are buying maybe $1 million plus or multi-million-dollar property. They have great jobs, have some wealth, etc. So they certainly I guess you say are approved for that. But again, if you're a lender and you originate this loan and then this loan can't be purchased by the government, that's a risk for you. And oh, by the way, because of liquidity issues, nobody's going to buy that mortgage-backed security or jumbo loans. So guess what? Liquidity is an issue. The risk is all upon you as the lender. You're going to pull back. So what we're seeing here is we're seeing people saying that much of this pullback is because investors who would normally buy these loans or no longer want them. Whether the assets are good or not good isn't relevant because there's no liquidity to buy them. So people aren't going to roll the dice or the risk. And essentially now borrowers are ready to put up 20% down. Now may need to put up 30%. A month ago, this was a no-brainer. Now, people are not sure what to do at this point in time. So again, this is just another indication where things always happen. So, these loans, higher price loans, jumbo loans aren't insured and they're risky. Lenders aren't going to roll the dice on this. So you've got, from people who can't afford to buy homes because of job loss, people who probably can afford them, but they're not able to do them because the lending's not going to be there for them. So basically, the market is coming to a stagnation or standstill right now. So funny enough, the other week I was talking about Fannie and Freddie and how they're not going to support, we'll call it, bailouts or things like that with their servicing companies, etc., because that's why they were put in place. They did that before. They put the stress tests in, etc. Well, looks like they've changed their mind on a few things. So Fannie Mae and Freddie Mac will begin buying some mortgages that are in forbearance, but there are a few catches. So citing the need to keep the mortgage market working for current and future homeowners during these challenging times, Fannie Mae and Freddie Mac will soon begin buying certain mortgages that are in forbearance. Now, basically, according to the GSEs, government-sponsored entities, that's what Fannie and Freddie are. Given the unprecedented rise in forbearance due to the coronavirus, FHFA announced Wednesday that it is allowing the GSEs to buy loans that go into forbearance within the first month. So basically, mortgage loans either in forbearance or delinquent are ineligible for delivery under enterprise requirements. However, today's actions lift that restriction for a limited period of time and only for mortgages meeting certain eligibility criteria. Eligible loans will also be priced to mitigate the heightened risk of loss to the enterprises from these loans. So basically what they're saying is that we'll buy a certain amount of loans. So the companies will only be buying loans that go into forbearance after the loan closing, but before the loan is sold to the GSEs. So really what happens is the loan closes with the mortgage originator and lender, then they're packaged and sold off to the GSE. So that's in between time frame is when they're going to buy that. Basically, simply put, the GSEs will only buy loans that go into forbearance within 1 month of the loan closing. So if it's been closed for a couple of months, it's going to be sold and it's in forbearance, they're not going to bother doing that. So basically, they're only buying loans in early forbearance for 1 month. This applies to mortgages with closing dates on or after February 1st, 2020, and on or before May 31st, 2020, and settlement dates on or after May 1st, 2020. So there you go. So essentially, loan forbearance with closing dates after May 31st will not be eligible for purchase under this new policy. This policy only applies to purchase of loans, of home purchase loans, not cash out refinances, and cash out refis are not eligible. So again, the GSEs, FHA, FHFA, whatever, they're stepping in to basically try to put some liquidity back in the market and try to help the servicers and the lenders that are out there. So they're offering a very small period of time when they could buy some of these loans and guarantee them. So that's not bad, essentially, but it's only for a shortened period of time. So it's not like, hey, we're going to buy all your toxic loan assets. It's only for a certain period of time. The other lenders, if they haven't had them sold off yet, or they've made their own, they've got their own issues, they're going to be stuck with those loans in forbearance. All right. Speaking of forbearance, here we go. Mortgage bailout balloons by 500,000 more loans in 1 week. So this to me is what I've been tracking, and I've been very interested to see how this is going. So just over 3.4 million borrowers, representing 6.4% of all mortgages outstanding, are now in forbearance plans. Okay, here we are. We're into really the third completed week of April, and that's 3.4 million borrowers. That's an increase of 477,000 loans in just 1 week, or nearly a 9% jump, according to Blacklight Financial. These forbearances represent $754 billion in unpaid principal and include 5.6% of all Fannie and Freddie Mac loans and 8.9% of all FHA and VA loans. So when you average it out, it's about 6.4% of all mortgages are in forbearance already. That's a lot of people in forbearance. So what does this actually mean? Well, it just means that we're going to see increases. So I would imagine that we'll probably see the last week of April, we're probably going to get the same amount, maybe a little bit less. So we're going to be approaching 4 million in 1 month. Then, of course, when May 1st hits, guess what? It's another month of, hey, maybe you could pay for April, or maybe you were employed in April when it started and you made your mortgage payment, but now 30 days have passed in April, and guess what? Something has changed in your economic or personal financial lifestyle, and you're going to go, I can't make my May payment. I'm going to call the lenders for forbearance. So this is where things are going to head. It's going to slowly unwind, and we'll just see this number, it'll keep ticking up for a certain period of time. And this is just government-backed loans here. So we're not talking about any other loans that are held by, private mortgage companies, Bank of America's, whatever. If they're not government-backed, we're talking Fannie, Freddie here, the GSEs, VA, FHA. This is government-backed loans. What we really don't hear too much about at this point in time is on the the Bank of America's, the Chase banks, whatever, Wells Fargo. We don't really hear too much about their volume of forbearance requests and where they're at. So realize that this is just a portion of the overall mortgage market. The HUD, Housing and Urban Development, has already gone, as we know, gone on record saying we'll offer forbearance, etc., through our servicing companies. We don't really hear too much about what the big other banks are doing with respect to that volume. Hopefully I can pick up those stats and we'll find out. So, basically there'll be more in a pool over here that we can't seem to get information on at this point in time. All right, so having said that, so we're up to, here we go, about just under 3.5 million borrowers in forbearance. That will play out as time goes on. This is what I want to talk about here. So essentially, a lot of times in business and in real estate, especially if you take a look at what happened with the last housing crisis and what happened with subprime mortgage meltdowns, people who are facing foreclosure and they talk to their lenders for help, etc. It's the old bait and switch. And it's kind of my topic of today. And that's why, of course, I left it for the very end here so I could bait and switch you guys to stay on the video longer. That was pretty good, huh? So anyway, the point, though, is that it's a crescendo. It's coming to the end here. So I saw this today in the Wall Street Journal. It says, getting a mortgage payment break isn't the boon many expected. which goes back to some of my thoughts and comments I've made over the past few weeks. Forbearance is not forgiveness, all right? That's not what it means. It doesn't mean your loan just goes, or loan payments go away and they'll, it'll just materialize somewhere down, 30 years down the road. It doesn't work that way. So basically, some are told they will have to make lump sum payments after forbearance ends. Others get confusing information. So if I go back to the last housing crisis, and please, I reference that quite a bit. Reason why? Because I lived through it on many different levels, and we saw what happened with hundreds of people that we dealt with personally in our business here. So back in the last housing crisis, people were the government said, help the people. Help the people. So guess what? The lenders said, well, okay, we're going to help the people. Well, you couldn't call and you couldn't get them. You couldn't communicate with them. The information was not clear. And people who were trying for loan modifications were often, and the majority were not approved, and they were disappointed because they kept faxing or sending the documents and they were lost, never received. The lenders, couldn't respond properly. And essentially the foreclosure process kept going, and people actually lost their homes even though they were attempting to save their homes, solve their problems, get into some sort of payment arrangement with the lenders, etc. So that's kind of that in a nutshell. We still have some of that going on today. Well, what will happen here is that, and we'll get to this as I talk about it here, but the stimulus package that Congress passed in March allows homeowners with federally backed loans to suspend monthly payments for up to a year without penalty if they face financial hardship. So yes, we know that. But the law, and this is the key phrase here, but the law doesn't specify what happens after the so-called forbearance period ends. Many borrowers say they are being told they will have to make lump sum balloon payments. Going back initially when the forbearance was discussed with the government and HUD and the whole bit, one of the, I think, the main issues or main goals that they were doing was trying to alleviate the chaos and the stress and to quell fears and the panic in the marketplace with the virus. So, people are going to say things as a short-term stopgap measure, not knowing the full solution or the full impact, etc. They want people to go, okay, I don't have to make my mortgage payment this month. And that's a little bit of a reprieve. As a matter of fact, maybe 3 months, 6 months, maybe even a year. Okay, great. That makes my life easier. I'm not going to stress about it because we're already in a big enough stressful situation right now. Okay, but what really hasn't been thought out and wasn't very clear at the time, and really I don't think it was just because they haven't thought it through. And as we can see, every day we're hearing something about who's going to back what, who's bailing out who these days. What's Fannie and Freddie going to do with respect to supplying liquidity to the servicers for people for them to handle the forbearance, things like that. So this is an evolving, we'll call it, real-time thing we're going through right now that nobody has the full answers to. So, they've quoted a few homeowners here, and one guy is saying they want to make it as difficult as possible for people not to give them their money. And when you take a look at this, that's a pretty profound statement, because what happens if I can't give you my money? Well, then I'm technically not paying my mortgage, and therefore, in technical terms, the lender has the right to file a foreclosure litigation and suit against me in order to get access and reclaim the property through the auction process. So this is where we're going to see a lot of stuff happen in the next little while, and that's where I always say that this is the crux right here. Here's what here's where we're at. People are getting, we'll call it the bait and switch. Okay, yes, you jump in, you can do the forbearance, that's great. So you've taken the bait. But when the time comes to pay, it's like, well, where's that lump sum? I don't have it. Well, that wasn't clear to me. Well, this is how our program works. So we're going to see how this evolves out. It's going to be kind of ugly. Basically, other people are saying, they told me if I can't pay it at all once, then I can do some kind of loan modification where I don't know what that means. So you see, right now, your average person is dealing with a lender who really isn't telling them what the full meal deal is here, and that's what's going to happen. So they're going to then, let's step back to, government mandates lenders and servicers to work with homeowners after the forbearance period to try to work something out. That's great. You can mandate me, and I'll send you the forms, Mr. Homeowner, to fill out for your what I call your request for mortgage assistance, and you're going to give me all the information. And by the way, you don't have anything to bring to the table to sort of pay up some of the missing payments, and your income is not good anymore, or you're still unemployed, or you're still not able to make ends meet, so guess what? We can't offer you anything. So now we have no choice as a lender except to put you through the foreclosure process. And then what are your options? Your options are do a short sale, which is a short payoff. Your option is to sell the home and move on if you have equity, but some of that equity could already be eaten up with respect to your non-payments. Give us the property back, which is called a deed in lieu, which means you walk away from the property and they don't take you through the full foreclosure process, but it's still technically speaking a foreclosure on your record. You know what I mean? And that's, or you do declare bankruptcy, and all you're doing now is just pushing the foreclosure down a few more months, down the road, because it will pop back in. So really, it's one of the things that this is so new and it's not been thought out. And I'm not criticizing anybody. I don't think it can be thought out. We have to roll with this on the fly here. The coronavirus relief package passed by Congress created no mechanism to test whether homeowners face financial hardship and left servicers on the hook for payments skipped by borrowers during the forbearance period. So what that basically means is they took away the whole you have to qualify to prove hardship to jump in the forbearance. So even though you may not have a financial hardship, you can just go to your lender and either go online and click forbearance or call them and say, I want the forbearance plan, and you're not paying. So it can work to accelerate the issues. People can take advantage of those issues. In the end, they may be thinking, you know what? I'm just going to walk away from my loan. I don't have any equity. There's many reasons people could do this, or I'm just taking a break from my payments and I'll put it on the market and I'll catch up, and when I sell it, who knows, right? But the problem is there was no appropriate application approval process for this. So basically, it's a destructive incentive that's going to encourage them to try to scare people, or at minimum tell them they're going to repay that in a balloon amount. So what they're doing now is because there's no qualification whether you really have a hardship or not, you haven't proved it, the lender's now going, okay, you got to pay this back. So i.e. maybe if you could have paid, you shouldn't have taken the forbearance. That's what they're trying to do here. Mortgage companies say they are simply following guidance provided by the Federal Housing Finance Agency, which oversees Fannie and Freddie, which is obvious. So the government went and said we can allow the forbearance, therefore all lenders are going, we're just following what the government said here. But basically, Fannie and Freddie last week advised mortgage servicers to tell borrowers that they will only have to repay their loans all at once if they can afford to. All right. Otherwise, servicers can work with borrowers to set up a repayment plan or change the terms of a loan. See, so this is exactly what's going to happen here. So you've taken a year off from paying your mortgage. So you owe, let's just say, $12,000. Your mortgage payment's $1,000 a month. You owe $12,000 at the end. All right. Thank you. Pay up. Give me the $12K. I don't have that. Okay, great. Well, we're going to do a loan modification. So can you make your normal loan payments? Yeah, I might be able to, or no, I can't. Okay, but we're going to we need all your financials. So now what you have to do is now you have to then get the request for mortgage assistance package. You need to fill out all that information, submit it to them. They have to review it, all right? And then once they review it, they go, hey, maybe we'll figure this out. So who knows what's going to happen at this point in time, all right? So that's kind of the scoop on that. And then maybe you qualify for a loan modification, maybe you don't qualify for a loan modification. If you don't qualify, what happens? Well, now you're going through the foreclosure process, all right? Once the forbearance is over and you're in the application process, they've probably started the foreclosure process as well too, because they're covering their bases. So this is where, it's going to be a bit of a mess here. So there's no mandate for how it's supposed to play out. An FHA spokesman said borrowers with a Fannie or Freddie backed mortgage aren't required to pay back their forbearance in a lump sum. The agency encourages borrowers who believes their mortgage servicers representing repayment options to contact the CFPB, which is fine. The whole point, though, is that this is where everyone's rolling the dice, because mandated to work with homeowners. So yeah, I'm working with you. I've given you my information. I'm trying to work something out, but you know what? It didn't make sense for us as a lender or servicer. Your income wasn't enough for us to do this. We have to recapture those 12-month payments over the next 24 months, and you can't afford that, so we're going to have to take it into foreclosure. All right. So just realize that's how this played out kind of last time in the housing crisis, and at this point in time, there's no indication that's going to be any different. So basically, a lady here is talking about Wells Fargo. She basically said, she spent hours on the phone with her lender, Wells Fargo, and was told Tuesday that she would have to make a balloon payment at the end of her 3-month forbearance period. Essentially, the bank said they have a number of potential options, but we need to talk to people directly to understand their circumstances. So this is where we're going to find ourselves in. So I called a bait and switch. I don't think it was an intentional bait and switch, but in the end, who does this benefit? It doesn't benefit the homeowner. It benefits the people who want to pick these properties up for cheaper than they can buy them now if things fall down a lot more. And that is one of my main concerns. So here you have homeowners that are following guidelines saying, hey, we don't have to pay our mortgage, the government's going to work with us, our lenders are going to work with us, and in the end, that may not happen. They're going to become victims again to what happened before, and they're going to lose their homes through the foreclosure process. Who benefits this? The big investors, real estate investment trusts, the hedge funds, whatever, Wall Street groups who are looking to vulture on this and pick up properties cheaper at the foreclosure auction. It's simple as that. It's this clean way of doing things. People can't afford their mortgage. They can't get into a loan mod that works for them. They get filed foreclosure. It goes to sale. Lenders get rid of the asset and get paid for it. Third-party bidder buys it, and essentially now they own the property. Those properties don't come back out in the market as distressed properties to help lower the price on average of properties that you and I could buy. They take them and they make them rental properties and keep them in house. So a lot of the stuff, I see this as the end of the last housing crisis is how this is going to play out this time, and that's a concern. But there's ways to work around this, and that's something that if you guys want to speak with me about, it would be good to actually engage. And by the way, today is Friday. I guess today is the 24th of April. I didn't mention that early on. I will be having a Facebook Live video tomorrow afternoon, so look for that. If you're not already, if you haven't sort of joined or liked or followed my Housing Bubble 2.0 Facebook page, please do so, and that way you'll be notified of what I got on the go here. I'm not leaving this medium. That's just a different way that I can do some more interaction, a little easier and off the cuff with respect to people who like to follow more and get more information. So having said that, thanks for the likes, views, etc. and comments. Please reach out to me about real estate investing. Particularly, the next little bit will be focusing on short sales. This is the next wave of short sales is coming, and I need to be prepared for it. It's going to happen in a couple of waves. A lot of my advisors and colleagues I've known for years have we've all been talking that this is the next wave of the short sales. So only 1% of the marketplace is short sales these days. I expect that will increase as time goes on. That's probably the best way that everybody out there can buy either a primary residence or an investment property with little to no competition and getting better prices than you'd find in the retail market. So anyway, thanks you very much. We'll look forward to speaking with you early next week.